What's up, you guys? I'm Dan, this is Frugal Not Cheap, and today we'll talk about how to get started investing. Investing is an incredibly powerful tool in order to reach your financial goals. The basic idea is that if you invest money, that money will compound and grow over time, meaning that you need to deploy a lot less capital than otherwise in order to reach your financial goals. These could be anything from a secure retirement to saving for a college plan for your kids, or even just achieving financial freedom at an earlier age. And something that I think is very important that we also talked about in our How to Get Started Saving video is that you don't have to wait until you have a whole lot of disposable income to put towards investing. You can get started anytime with some very, very low amounts. And actually, it's really important to start as early as possible because every dollar you invest now, early on, is going to mean much more in the future than any dollars that you invest later, 5 or 10 years down the line. In fact, you could save up a retirement portfolio worth $1 million after accounting for inflation by the time of retirement if you started putting away a car payment every month at the age of 20. Now, you don't have to put away that much. You can get started investing with much, much less. A couple of things before we get started talking about investing in earnest, though, is that there are some things that are a higher priority, and I would encourage you to take care of those things first before you look into investing. With one little exception. So, first thing is, of course, if you have a lot of high interest debt, anything that's over, say, 5 or 6% would be a higher priority. And the reason why is that historically, you'll probably get about 10 or 11% return on your investments before inflation, 7% after inflation. But that's a not guaranteed return. That's like an average over a long period of time, right? Whereas with your debt, the interest rate is known, and so the return on your investment of paying off that debt is a known quantity. In other words, if I can get a 6% for sure return on paying off my debt versus maybe these higher returns on the investing, then all else equal, it would make more sense to tackle my debt. All right, so that's one important thing, is to take care of high interest debt. Then the other thing that would be a larger priority, I would say, before investing is to take care of your emergency fund, because we want to be able to take care of these things as they come up. If we don't have that fund, then we might have to take the high interest debt that we want to avoid, and so certainly we want to have those two things out of the way. There is one exception to this thing about the high interest debt, though, is that if you have a 401k match at work, it would make sense probably to go ahead and try to get up to the 100% match, because there we're talking about a guaranteed 100% return on your money if the funds are matched 1-to-1, and that's going to beat even the 17 or 20% APR that you have on your credit cards as well. So in that case, you have two known quantities, and you have one that's a much, much larger quantity than the other, and so then you might want to start paying, doing the 401k match, and then tackling the high interest credit card debt after that. All right, so to summarize, I would say that we want to build the emergency fund, then we want to take care of our high interest debt, and if you've got credit card debt where the APYs are, the interest rates are really, really high, 19, 20, even higher percent, your hair is on fire and you've got to take care of that really quickly. Mr. Money Mustache always talks about that as a hair on fire emergency. But the one caveat to that, again, is if you can get the 401k match, then you can get a 100% return on your money, and so you should start with that as well. So today I'd like to cover a few different questions you might have about investing. First, we'll talk about why it's better to start early. The earlier the better. Then we'll talk about what kind of an account or vehicle you should use, tax advantaged. Then we'll also talk about how much it should cost and trying to avoid fees. Then we'll talk about what to actually invest in, right? Because it's not just about saying, oh, I'm going to invest and picking the company and all that. And then finally, we'll discuss some different options for companies that you might use. So, why is it better to start earlier? Or another way that I like to say it is that the best time to start investing is now. Well, as we stated earlier, you could become a millionaire by the age of 65 if you started saving at the age of 20, investing at the age of 20, and you were earning around 7% after inflation as an average over that period of time, and you were putting away just $300 a month, like we said, around the average American car payment. We've got the math here from a website called investor.gov that has lots of good information provided by the government about investing. I highly recommend to check it out. But anyway, you can see that we would have about $1.02 million by the age of 65, putting that away. And again, this is after inflation. So the actual nominal number, or not inflation adjusted number, you'd see would be much, much larger. But in today's dollars, we would have $1.02 million worth. You can try it yourself and play around with the numbers and get some ideas about different scenarios. I've put a link to that calculator in the description below. Here's another way to look at it, and I think this is hopefully going to be a really, really powerful motivator. So what I've done is I wanted to compare how much you would have by the age of retirement, again also in inflation-adjusted dollars, so today's purchasing power dollars, if you put away just $1,000. Just $1,000, not $1,000 a month, but just $1,000 one time at the ages of 20, 30, 40, 50, and 60, and then see how much we have at the age of retirement at 65. As you can see here, the difference is staggering. Albert Einstein, I think, called compound interest something like a miracle or magic or something like that. I'll put the proper quote up. But anyway, his point is really, I think, quite true. It's really an amazing thing, this compound interest. So exponents are very powerful. And what you see is that you have very, very slow growth at first, what it looks like. But because it's an exponential, then it accelerates very, very rapidly until it's almost a straight line upwards. It's insane. And so that's what you see with investing. If you're able to invest, it's really just a matter of compounding in time to create a vast fortune. And we can see here that if we invested $1,000 at the age of 20, then at the age of 65, we would be left with $21,000. So we can see that every dollar that you invest in your youth is worth about $21 at the age of retirement. That's a huge, huge multiple and something you absolutely want to take advantage of. And again, that's after accounting for inflation. Meanwhile, if we waited another 10 years to get started into our 30s, like many people seem to do, then that dollar would still grow a lot. It would grow to almost $11, which is tremendous growth, right? An 11 times multiple, but nowhere near as much, it's half as much as it would have been if you'd put that money in 10 years before. And again, that's because of this compounding and the exponent function. Then if we wait even another 10 years after that and begin in our 40s, then our $1 becomes only about $5.40. Now still, getting 5 times your money sounds really great, and it's in a relatively short period of time, 25 years. Well, all right, maybe that's not doesn't sound so short to you, but when we look at these kind of time horizons, it is. Anyway, it's still, quite a bit of growth, but nothing like it was if you put the money away in your 30s, and very much nothing like if you put the money in your 20s. And then as you can see in the scenarios here for when you start saving in your 50s or your 60s, then you're just not getting the multiples. We're looking at 2.7 and I think 1.4. So really just you need that time in order to grow. And so even if you're not able to invest a lot right now, but you're in your early 20s, or ideally you just turned 18 and you can start opening up your own accounts, this is the time to start. Every dollar you put in now, again, could grow 21-fold. And of course, the irony of it is that when you're young, you don't really... that long future doesn't seem all that real to you, but man, this is powerful. I hope this motivates you. It's very powerful, and you can accumulate quite a lot of financial freedom if you get started now. Now, I should say that when we talk about getting started now, right, that doesn't mean that now is sort of a low point in the market and it's going to be going up from here. We know that the long-term trend is up, and so if you've got a line that goes like this up over the long run, then of course the earliest you can get in on that, then that's the better. But that doesn't mean that there aren't going to be lots of fluctuations in the market. Tons of recessions, there are going to be crashes. You've seen '08 or heard about '08, and there's going to be something like that again. We had a pretty good crash here when the coronavirus hit in 2020 as well. These things are going to happen, but in the long run, the best time to get started is now, and no one has a crystal ball. So no one can tell you that, tomorrow the market's going to fall or tomorrow the market's going to rise. In fact, if you watch the news, most of the time what they do really is if the market's falling that day, they call up all the guys that are bearish, like the people that talk about how doom and gloom and the market's falling. And then on the days when the market's doing really well, they have another set of people that they call up that are always the bullish ones, the optimists, and they get those people on the news, and they'll just, rotate back and forth. So speaking of the long run, here you can see the inflation-adjusted S&P 500, so again accounting for the loss in purchasing power over time, and you can see that long upward march, but with a lot of fluctuations along the way. And if we look at that history going back to January of 1925, the returns through December of 2020 did average, after accounting for inflation, right at around 7%. All right, so hopefully that was good motivation for you to get started now, and that the earlier we start investing, the better, because it means we have to invest much less to get the same results. Now that we're going to invest, where should you invest? In other words, what kind of an account should you use? And this is something that can be confusing for a lot of people, because there's a whole lot of jargon, and there's a lot of sort of concepts that aren't something we talk about every day. So the first thing is, basically there are two classes of accounts. The first one are tax advantage accounts, and then there are the non-tax advantage accounts. And then among the tax advantage accounts, you've got two kinds. We have the pre-tax and the post-tax accounts. All right, so try to break it down. The non-tax advantage accounts, what I'm talking about there is a regular brokerage account. So you would just open an account with some brokerage and start investing. And the money you'd be putting in here would be money that you've already been taxed on. So it's after-tax dollars. You don't get any kind of special advantage with your taxes. That's probably going to be, I would say, lower down on the priority list, because you would want to take advantage of the incentives that we have in our tax system to the greatest degree that you can. Why not? These incentives exist in order to incentivize us to use them in order to start saving for our future, investing in our future. So among the tax advantage accounts, again, you've got two kinds. There are the pre-tax accounts. So this is where you get to put in money before you get taxed on it. In practice, the way that works out is you put in the money and then you just don't pay taxes on it, right? That's kind of how it works. So there we're talking about your traditional 401k and also what they call a traditional IRA, which is an individual retirement account. So there are those two. And the benefits there are that because you're not paying taxes on the money, then it frees up more of your money in order to invest now. And as we talked about, the longer that you have for that money to grow, the better. So in that way, it's very advantaged. Now, you will have to pay taxes on the other side when you're taking the money out. But there are some reasons, especially if you're more frugal, that you shouldn't really be all that concerned about that. And I'll talk about that more in future videos. But for now, I'm just going to put a link to a really wonderful piece of work done by the Mad Fientist. I think if you saw my first video, I was wearing one of his t-shirts here, the one about the Note 20 Ultra that we're filming this on. But anyway, there he does the math. And you'll be able to see why it is that these pre-tax accounts beat the post-tax accounts generally in many use cases, even though you're going to have taxes that you have to pay on the other side. All right. Then the other kind is the after-tax or the Roth type accounts. That's R-O-T as in Tom, H as in Harry, Roth. So these Roth accounts, you can have a Roth 401k, though they don't seem to be all that common. I have that option, and that's to put in money into your 401k at work after tax. So you've already paid taxes on these dollars, but the benefit is that they can grow within this tax-sheltered account tax-free, and then you don't pay any taxes on the way out when you cash out the account or parts of the account later on down the line in your retirement. So there's the Roth 401k, and then there's also the Roth IRA that you can do as well. Again, the individually done account, which would be outside of your work. All right, so I would say, again, if you've got a 401k match, you're absolutely going to want to start there. That's free money. You got to take it, right? Really ought to take it. That 100% return even beats, again, the interest rate on your credit cards, so it's pretty amazing. But after that, you want to consider, is my 401k really the best place to start? So I guess what I would say is, the match is number one. And then the next thing would be probably my 401k at work, but we need to dig into the fees. Right, so we'll talk about this more in the next section of the video, but fees are really, really important. And so if you've got great low fees, I'm talking like 0.1, 0.15%, stuff like that, then the 401k might be a really good option. If you've got fees in the 1% and above range, then I would say start. start filling up an individual retirement account, and then once you've done all that you can there, then you might look at the 401k. But if those fees are really bad, then you might even start looking at a brokerage account instead. So the fees are really going to determine that. Now, when I say about filling up the IRA, what I mean is that currently, so for 2021, you can put $19,500 into a 401k. All right, that's the limit. And you can also put in $6,000 into an individual retirement account, an IRA. So if you've got terrible 401k fees, you might put in your first $6,000 for the year into the IRA. And then if you have more, then you might look into either the 401k, or if the fees are really terrible, then a brokerage account. By contrast, if you have a really good 401k account, like at my work, we have Vanguard, then you might start with the 401k, and then if you're really, really fortunate, you can fill up that whole $19,500 in the year in the 401k, then you might look at doing an IRA. And at that point, your income probably puts you into the Roth category, but not sure, because yeah, the tax advantages for the Roth, the traditional Roth IRA, do phase out as your income goes up, and that will push you more into the Roth category. But either way, the point is take advantage of the tax advantage accounts first, and then start looking at brokerage accounts. Unless, of course, you're trying to get at this money within the next 10 years or something like that. But really here, again, the focus is mostly on the long-term financial planning, where we're looking at getting these funds later in life. Saying that, there are some ways around that and to get access to the funds a little bit earlier. One's called a 72T, and the other is called a Roth conversion ladder. So there are ways, and so even if your investment horizon is more like 15 to 20 years for financial independence, retire early, or FIRE, then there are ways to do that as well. All right. So we're going to invest as early as possible, and we're going to invest in tax advantage accounts if we can. Now we want to look at fees. So we absolutely want to avoid fees, and I just want to highlight the point about how impactful these can be over time. So again, investor.gov has a lot of good information here, and they show us what the impact of fees will be over a period of 20 years with $100,000 invested. If your fees are just 1%, which is what a lot of financial advisors might charge for their services, then you would actually end up losing $30,000 in gains on your $100,000 investment. So pretty big. And if the fees being charged were half of that, still pretty low. It sounds pretty low, right? 0.5%. You would still lose $10,000. So 10%, right, of your initial investment. So these fees become a really big deal because of compounding. So just the way that your investment grows on a compound rate, and the impact of that rate becomes bigger and bigger over time, then the impact of the fees is also compounding. So the longer this horizon, if we were looking at 30, 40 years, you'd see the impact of those fees go up exponentially as well. So it's a really big deal. Okay, so we're investing now, we're doing tax advantaged, and we're going to avoid fees as much as possible. So what should I invest in? Because choosing the type of account, say the 401k or the Roth IRA, isn't the same thing as deciding what to invest in, right? So this is it's an account that holds something, right? Holds your investments, just like your savings account holds your dollars. You got to put the money in something. So we need to decide what to invest in. And in order to do that, well, I can't do that for you. And so what you should do, what I would do if I were you, is to take a quiz. So this is the same kind of thing like when you sign up for your 401k at work, it has a quiz that tries to assess your investment goals. In that case, it's retirement anyway, but there might be other ones. And so in the quiz that I will link down below, you'll be able to take a look at that. And it'll also assess your personal risk tolerance. Everyone has a different view on risk. So this is something personal that only you can determine for yourself. So I highly encourage you to take the quiz down below that's provided by Vanguard. But generally the results of this quiz are going to be a suggestion on how aggressive your portfolio should be. And so by aggressive, we mean how much risk are you willing to take in terms of the fluctuations day to day and month to month. So how aggressive your portfolio is really a relation of how much you have invested in stocks versus bonds. So stocks are shares that you own, little small pieces of companies that you own. So each little piece of a company is called a share, and you are buying shares in that company. So you're becoming a part owner, actually. And if the company does well and its valuation goes up, your shares will appreciate in value and your investment will provide a return. The other way is if that company provides some dividends. But again, because these shares are traded in the market, then there is risk and the values can fluctuate over time. Now the other one is bonds, and what we're talking about here is really debt. So you're really just lending money to the company, and in exchange they provide this bond that says they're going to pay you, some certain coupon payment or what have you. But anyway, basically we're just lending the money, and then they're paying us back interest is really what the idea boils down to. And because those interest payments are fixed, then that risk of the fluctuation isn't there, and that's why they're considered less risky. Of course, the companies could default, but that's why we lend to a ton of different companies in the bond fund, and so the individual risk of one particular company just really won't affect the aggregate. And so that's very important. And that's something on the stock side too. So again, when I talk about buying stocks, I'm talking about buying an ETF or an index mutual fund, and where you're buying a large set of companies, because owning one individual company is very, very risky. So it worked out very well for me in Tesla, but again, that was just because I believe in their mission. It's not something that's part of my whole overall investment philosophy. Maybe there's some room in your portfolio for a little bit of that kind of thing, but it shouldn't be the basis, or at least I don't think it should be the basis of an overall portfolio for me. Alright, so this quiz will help you determine your personal risk tolerance. The higher your risk tolerance and the longer your time horizon, so especially if we're looking at retirement, the more it's going to suggest that you invest in stocks rather than bonds. And then over time, we might trim that, change that ratio, and reduce the amount that we've invested in stocks and increase the amount that we've invested in bonds, so that the money is there and the values are fluctuating less as we get closer to the point where we'll start withdrawing those funds. So what are some examples of things that we might invest in? Well, of course, you've got things like VTSAX or VTI. These are the mutual fund and ETF version of the Vanguard Total Stock Market Index Fund. So here we're looking at the total US stock market by market capitalization. This is similar to the S&P 500 but broader. So the S&P 500, of course, is just 500 companies. This will be broader. You could look at an index of the total global stock market as well. Typically, there's like an option for the total US stock market, and then another option for the total international stock market, so non-US. And then, of course, you'd want to look at US bonds, and then also international bonds as well. So these four can be the basis for a really well-diversified portfolio. One other thing that many people are into adding to their portfolio are REITs, real estate investment trusts, to give them some access to real estate as well. But in my view, in practice, it's not the same thing as investing in real estate. You're investing in companies that invest in real estate, and a lot of that is already in there in the total stock market funds, but it is an option. So you could do a 5-portfolio fund that way, with REITs, total US, total international, total US bonds, and total international bonds as well. And that would pretty much cover the gamut. So that's one idea for a portfolio, and I do think it is really important to learn about this stuff yourself, and we will be covering in detail what all those things mean to a much greater degree over time in future videos. But this is just to get you started, and you should do some research as well, and on whatever company you end up investing with, their platform will have some tools to help you learn more about all these different things and all the jargon. So jargon's always off-putting because you're not familiar with it, new words, but once you know what they mean, then you see that it's not all that complicated, really. The financial world likes to use a lot of jargon to make you think that you couldn't understand these things, but it's not true. You can absolutely learn these things. Okay, so which company should you go with? Well, again, the big thing here for me is avoiding fees, right? And learning about these things and doing it yourself. So across that spectrum of the fees and also the amount of hand-holding, because they go together, right? The most expensive things with the most hand-holding are things like your Edward Jones. You might have heard of those, where you have a local office with a local financial advisor, and you can call him up, and he'll give recommendations, and he tries to kind of do everything for you. And While there's a place for that maybe for some, it is expensive. And the other thing is the incentives are kind of screwed up. And I might talk about this more in a future video. But these guys typically make money by sometimes putting you into funds that have loads. So they essentially get a commission for you, selling you into a fund. And then they can make that commission again and again if they move you from fund to fund, which is called churn. Just the short of it is there are a lot of ways that these so-called financial advisors' incentives are actually aligned against you because they can make money doing things that aren't in your best interests. So personally, I'm not into it. But if you are willing to pay in order to have that kind of an experience, then I guess that's an option. So that's the most expensive one. And then you have some of the more kind of older and established brokerage houses like I don't know, like Merrill Lynch. They'll have a financial advisory and companies like that. So those tend to be also more expensive, but not as expensive as Edward Jones, where they have the local office and these what are they called? American Life funds. I'm not trying to single them out or anything like that, but I've seen some awful fees there. So yeah, not for me. Anyway, so you got Merrill Lynch and those guys. And then below that, I guess in terms of less fees and less hand-holding would be what they call the robo-advisors. Things like Betterment, Acorns, is it Ellevest, M1 Finance. So all these guys. And aside from M1 Finance, they all have a fee that they charge. And then that's on top, of course, of the fee that's charged, the expense ratio, the expenses associated with owning the funds that you'll end up investing in. So they are a middleman, and they are more expensive in that way. But what they're supposed to do is provide some benefits like tax loss harvesting. I'll cover that in a future video. Rebalancing, which is just at the end of the year or so, looking at your portfolio and seeing if it's moved away from your targets. So like, let's say you were supposed to have 80% stocks and 20% bonds, and at the end of the year, stocks did really well that year, and now you were at 85-15. Well, you'd sell some stocks, buy some bonds, and rebalance to 80-20, or vice versa. If there was a recession and the stocks fell down, then you'd sell some bonds, buy some stocks. And the cool thing about this is that then you end up buying stocks when they're relatively low because they've fallen, right? And then the same thing with the bonds and so on. So it's just a matter of keeping that portfolio in balance according with the targets set by your personal investment quiz. So these are some things that the robo-advisors can do for you automatically. The computers can just do that for you. And they can also help generate a portfolio for you. So like we talked about that the 5-fund portfolio not long ago. That's something that they could basically come together with for you as well. But again, there are some drawbacks to this. So most importantly for me is that, of course, there is that fee that they charge, right? So there is a cost to it. Aside from M1 Finance, I think they don't have a fee. They make money instead by lending the shares out. And then also they have some really interesting spin on this one. But I think they use dark pools. And so essentially they get paid for order flow to send your orders to other places. Oftentimes those guys will front run. Oh man, there's a lot of jargon, but basically they have ways to make money that aren't necessarily great for you or for the market as a whole, in my view, anyway. But there is you won't see the fee in the same way that you will with the others, and it is lower than with the others, and so that might be a better option than Betterment or Wealthfront on that basis alone. But as far as sort of what their fund selection is like and the rest of the platform, I don't know, and I don't want to go into detail about that with this particular video. But what I would say is that, yeah, the robo-advisors, they do cost a fee, so that's a con. And the other con is they tend to put you in some really complicated portfolios, like way too many different index funds that you don't need to have all of those. And it makes it hard if you ever decide to leave. You might not be able to transfer all of those in kind. which would then force you to sell them at a time that you might not want to sell them and take the tax hit. Because a lot of these are designed to go into your after-tax brokerage type account situation. Some of them do offer retirement accounts though, and in that situation you wouldn't have to worry about that because those sales, you wouldn't have to pay taxes on them at that time. So that would be safer. So I would say, if you really don't want to learn much about investing, which, I don't know, you probably wouldn't be on this channel then, probably. I don't know. But yeah, if you really didn't want to learn anything at all, maybe the robo-advisors would be an okay choice. Certainly cheaper than like Edward Jones or a traditional account at Merrill Lynch or something like that. But there are some drawbacks again. You won't get as high returns possibly. Well, anyway, there will be fees, and it might be kind of hard to get out of unless you do a retirement type account with them, a tax advantaged account. Yeah. And then, of course, the cheapest thing to do, and the thing that I personally do, is to use one of the what I call sort of the holy trinity of low fees would be Vanguard, because they're the ones that spearheaded this whole thing. They were the vanguard of having low fee index funds. Then there's also Fidelity and Charles Schwab. So all of these offer very low fees. In fact, some of them even offer zero fee funds, again, because they lend out shares and do dark pools and stuff like that. But anyway, still very, very low or no expense ratio funds. And especially Charles Schwab, I found, has great customer service. I've heard Fidelity has good customer service as well. Vanguard's is maybe a little bit more limited. It's still good in my experience. But the key difference about Vanguard, and the reason they keep stocks so low, is that as an investor in Vanguard, you're actually a owner of Vanguard. So I'm an investor in Vanguard, and every year I get to vote on things just like a shareholder would at any company, which is really, really cool. Any of these three would be good to go with. My personal favorite is Vanguard. They've got really, really low fees, and this investor-owned kind of company structure is unique. There's a reason why they have so many assets under management, and they've been so incredibly successful. And there's another reason why I recommend Vanguard. So we talked about that 5-fund portfolio. So you could do that, and then you'd have to rebalance at the end of every year, or the 4-fund actually, because I don't personally do REITs. But again, yeah, you'd have to rebalance at the end of the year, and it would take some work. One of the easier things, and one of the things that often the people that I work with end up choosing to do, is to do a target retirement date portfolio, a target retirement date fund. So you just buy this one fund. It's set up with your personal investment horizon in place already, because it's a target date fund, like to retire in 2040 or 2050 or whatever it might be. And it also rebalances for you automatically. And it changes the allocation from a more aggressive target early on to a more conservative target as you approach retirement. So it does all that stuff for you. Doesn't do the tax loss harvesting like the robo-advisors do, but that's something that you can do yourself in a a brokerage account later. With the target date funds, these retirement funds, not that big of a deal, because you're already getting the advantages from them being in a tax advantaged fund like a 401k or an IRA. And so again, Vanguard would be better here because Vanguard's fees are very, very low for these target retirement date funds. For instance, for the target date 2040 Vanguard fund, the expense ratio is only 0.14%, so that's extremely low. But the fees for the target date funds for the same year from Fidelity and Schwab, and again, these three are generally the lowest fee brokerages out there. We're looking at 0.65% for Schwab and 0.75% for Fidelity. So those at that level, those fees are, I think, a little bit too high for anything that I would recommend. So if I were going with Schwab and Fidelity, I would probably build my own portfolio. But if I was looking for the easiest thing to do, I would go with Vanguard, and I would do one of these target date retirement funds. So you'll see these target date retirement funds tend to have a $1,000 investment minimum. But that doesn't mean you have to wait to have $1,000 to open the account, right? So you can go ahead, open the account, and fund it with whatever you've got. It can be a $50 check or a $100 check or whatever, $25, doesn't matter. Just tell them that you'll be funding it by check or by a transfer later on. And what that'll do is the money that you send in will get invested in what's called a money market mutual fund. So it's basically cash that can get lent out, and you can earn a little bit of interest on that. And just start contributing, right? Start investing over time. Just having the money using up these tax-advantaged account spaces is a really important thing to be doing anyway. And then once you've built up to the $1,000, which will happen sooner than you think, then you can buy your first bit of the target retirement date fund at Vanguard. And then once you've started with that $1,000, it's not, you don't need to get another $1,000 before you invest more. They'll take any amount. So you can invest just $20 a week or $30, whatever it might be, and it'll continue getting invested right away in that mutual fund. And so I think that would be a great way to go, or at least anyway, that's a way that a lot of people that I've worked with have gone. Nice and simple, and hits all the buckets and gets you started towards your financial goals. And hopefully they won't look at these accounts all the time and try to trade in and out. They're just going to let them sit, right? Let the stuff grow like we saw with that compound interest, and by the time that they're looking to access those accounts when they're 65, they'll see some very, very nice growth if history is any guide. So I hope this has motivated you to get started investing. Again, if you've got some high interest rate debt or especially a hair on fire credit card emergency, take care of that and your emergency fund first, unless you've got the 401k match. That's a really, really big one to get. But yeah, having taken care of those, let's get started investing. Let's start that compounding as early as possible so we can get those goals achieved with as little money invested as possible. Hope this is helpful. If you liked it, hit the like button. If you'd like to see more videos like this, hit the subscribe button. If you'd like YouTube to notify you when new videos are posted, ring the notification bell icon. Oh man, that's a lot of stuff. Anyway, hope this was helpful. Sincerely, I really hope it was helpful, and I'll see you in the next video.